Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you today about how to effectively trade ranges. Ranges at first appear very simple. You buy low, you sell high, you buy low, sell high. You can even sell short, buy back low to cover the short, sell short again, buy back low to cover the short. And a lot of people will play both sides of a range. Buy here, close the long here, sell short here, close the short here, go long here, etc., and just keep flipping these positions where they're constantly in the market. Here's the problem with that, is that you're going to eventually have a breakout like what we have here, and you don't want to get caught on the wrong side of it. So how do you reduce the chances of getting caught on the wrong side of that trade? There's two ways I want to show you. One is to think about which side has the fundamentally stronger scenario. Would it be, in this case, Aussie, or would it be the yen on this 4-hour, 40-day chart? Right now, well, Aussie just added jobs in their employment report. How many countries out there are adding jobs right now? Most are losing, and it's positive if they're losing less, but they're still losing jobs. Their unemployment rates are increasing. Australia was the first G8 currency to add or to raise interest rates. None of the others have felt that their economies were strong enough to be able to endure that. Money is attracted to higher yields, higher interest rates, so there's money flows that would be biased towards the Aussie and not so much the yen. So you would want to buy and then sell, but not short. You would just simply want to let it come back and buy again, sell, buy again, sell, because it's going to break out, and when it breaks out, it's going to shoot up and go against you and take back a whole lot of profits. Keep in mind too, a lot of ranges aren't this long. This is a 40-day chart, so this range has been lasting, for a good 40 days or so. Because a lot of people say, well, you could short here and go long here and so forth and play both sides, and then when it breaks out, yeah, you'll get back some of it. But keep in mind, a lot of ranges, they may be half this length. And so by the time you have the breakout, you've given back a good bit of your profits. You also want to keep your stops wide, because you'll have little spikes outside the support zones and the resistance zones. And notice I draw zones or regions because pairs don't stop down to an exact pip. They need a little bit of leeway, a little bit of room to turn around in. Currencies turn around like ships, not like speedboats, and so they need a little room to turn around in. And then how do you determine your stop distance? Well, I can take the length of this range and see how many pips it is. I can cut that number in half and count back half as many pips back from my entry point. Or if I'm, if I were shorting and I sold here, remember on this pair I would not want to because it's fundamentally stronger. But if it were the case where we're fundamentally weaker and safer to be on the short side, I could short up in here and then take half the pip distance range and put my stop up here. And that way I've still got a good risk to reward ratio, risking one part to gain two parts. And so that's a healthy risk to reward ratio. But fundamentally, you're eventually going to have a breakout, likely to the upside in the right fundamental direction. Now, there's another way to do this too. Let's say you don't follow or know the fundamentals of a country's currency, because when a lot of people get into currencies, they don't know a lot of this stuff. So here's another even easier way. I'm going to go to the daily chart. And this is the last little bit of data that we were looking at, which was about the last little over a month, 40 days. And we see our range here, still these very same lines. What you need to do is look and see how the pair traded going into the range. So this pair had trended up and then consolidated in a sideways range. Statistically, it is more likely to break out in the direction that it was trading before, which was upward, once it breaks out of the consolidation. Why is that? Because you have, even on a miniature scale, you have trend, consolidation, trend, consolidation, trend, consolidation, a little bit of pullback, trend, consolidation, etc. So this is just a longer, on a bigger scale, a big move up, a big consolidation. Statistically, you're standing a huge likelihood of the next move to be heading upward. And it doesn't mean it absolutely has to, but since trends don't change that often, and trends tend to form because of the fundamentals, and the fundamentals don't change all that often, all that quickly, then that's where your statistical likelihood stands. So you can go back to your 4-hour chart, and keep in mind you can do ranges on other time frames, but you're going to have the larger time frame you'll choose, the more pips that you'll potentially have to work with per your spread costs. So I would rather pay a spread of 3 pips and have, gosh, what do we have here? Like you've got a good 300, 350 pips here in this range, depending on whether you go narrow in or the wide areas of it. So I would rather pay a few pips and have potentially a few hundred pips than to have, drop down to something really small like a 5-minute chart and pay a few pips and have, say, 10 pips of potential gain. The risk to reward, just taking in the spread alone, much less if I were to lose in the trade, just makes it not worthwhile. So this is why I would suggest trading ranges on hourly charts, 4-hour charts, daily charts, things of that sort, because you're going to get these big swings. Because what's the chances of you taking the meat out of one of these moves on a bigger swing move, versus one where you have very small potential, 10 or 15 pip move, and you got to try to get the bulk of that. So if I've got a chance to get a few hundred pips here, or a few hundred pips here, or a few hundred pips here, what's the chances of getting 50 or 100 pips out of that huge move, or even 100 of the 300 or 150 of the 300 is pretty good. I'm probably not going to get 295 or 250 pips of the move, but I will get the hopefully a good bit out of the run. So those two methods, knowing your fundamentals and which one is your fundamentally stronger of the two, and also backing out to the larger time frame to where you can see where the trend was coming from before it went into the range, helps you to know also which direction your breakout is likely to come in. So what you want to do is always position yourself on the side of the range that would complement the breakout. In other words, had I been long here and it went up to here and it happened to break out on me, well, that's okay. That's just extra pips that I've gained. But if I had let it go up here and shorted against the strong fundamentals and against the bigger, larger trend, and it broke out, now I'm losing and giving back some of the gains I had on this move. So that's what I wanted to point out for the chart of the day. Thanks so much for attending.